Hey everyone, let's dive into one of the hottest debates in the world of investing active versus passive management. I'm here to break down why passive investing, especially through S&P 500 funds, remains a compelling choice for so many investors. Today, over $7.1 trillion tracks the S&P index. But why are investors flocking to passive strategies? Well, the answer lies in decades of data and clear market observations. First up, let's talk about the struggle of active managers to outperform. Since the 1970s, it's been evident that most active fund managers fail to consistently beat their benchmarks. The SPIVA report, which stands for S&P Indices Versus Active, highlights this stark reality. Over a 20-year period, around 94 to 95% of active managers underperformed their respective indices across large, mid-cap, and small-cap stocks. Only 3 out of the past 21 years saw the majority of active managers beating their benchmarks. This shows just how unpredictable and challenging it is to sustain outperformance. But why does active management often fall short? There are 3 key reasons. Number 1, professionalization. The marketplace is dominated by professional investors, all competing against each other. For every investor who outperforms, another must underperform. It's essentially a zero-sum game. As more investors shift towards passive funds, the least successful active managers are forced out, leaving only the most skilled behind. This ratchets up the competition, making it even harder to outperform. Number 2, costs. Active funds typically charge higher fees, an average of 0.68% compared to just around 0.06% for index funds. Since an index fund owns a proportional slice of the entire market, the overall returns before fees are identical to active portfolios collectively. After fees, active management typically trails passive indexing. As William F. Sharpe famously articulated, the arithmetic clearly shows active management is structurally disadvantaged after accounting for costs. And number 3, return skewness. Stock returns aren't evenly distributed. They exhibit positive skewness. Losses are capped at 100%, but gains can far exceed that. Historically, the S&P's average return consistently exceeds its median return. For example, from 2002 to 2021, the median stock gained just 89%, while the index itself soared 517%. Only about 18% of stocks outperformed the index during this period. This means active managers must find those rare winners significantly outperforming the index, a daunting task. So, what does this mean for the future of passive investing? Currently, passive strategies represent about 20% of total market assets, but only around 10% of trading volume. Even if passive investing expands significantly, market efficiency remains robust. To wrap it up, the active versus passive debate is clear. Active management faces ongoing and significant challenges due to professionalization, higher costs, and the inherent skewness in stock returns. These factors strongly suggest that passive indexing, especially through low-cost funds tracking the S&P 500, will continue to be the smarter choice for most investors. Thanks for watching, and happy investing. For more insights and to see the S&P SPIVA presentation, visit danmahonyoninvesting.com. Get more information on investing using the Buffett plan.